All right, welcome back. We're sort of counting down to the pre-open session. Naren is one of India's biggest fund managers. He's Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company. Naren, great to have you with us here. Thank you very much for your time. Prashant this side. I'm going to come to you. I just want to quickly play out this soundbite, and I want you to listen to this as well, because my first question is going to be that. This is Finance Secretary TV Somanathan on, the revision in the taxation to 12.5% and 20%, and whether there'll be more coming in the next 6 months. That is the next budget in February. Listen in.
88% of the value of capital gains earned in India, according to our study, comes from people whose returned income is more than 15 lakh rupees. And 62% comes from those who are above 1 crore of returned income. So this is not a tax which is falling predominantly on the not at all.
Class,
this is the class of income which Thomas Piketty and others have been writing about all the time. Now, at some point,
it then begs the question: are you looking at a higher rate? Because that's the worry, that you've done 12.5. This is perhaps an odd rate.
If we were looking at a higher rate, we would have done it.
But maybe you're testing waters with 12.5, and maybe
we don't believe in testing waters.
So is it going to be 12.5 now for the near term? I mean, for the next few years?
There is no intention to revise it from here. I cannot speak for all the future finance ministers and finance secretaries, but I can say as of now, we have no intention of revising this any further.
So 12.5 is...
Of course, no one can predict the future.
No, absolutely.
Somebody else may cut it too. I can't predict that. But what I am saying is we need equity in taxation. We can't say that only equity markets take risks and a person doing an MSME business is not taking risk and he should pay 39%. And because I'm taking stock market risk, I should not even pay 12.5%. There is a case for a lower rate on capital gains tax. It is much, much lower than the marginal rate of tax on other sources of income. And it's creating distortion in the savings markets also.
Naren, thanks for listening into that. So the assurance that it's going to be 12.5, not more. So I want you to react to that first before we get into markets, etc.
I think basically the markets can absorb it. That's why you would have seen yesterday that the market basically closed almost flat. And so from that point of view, I would say markets can absorb, equity markets have the capability to absorb at this point of time, given the kind of inflows that the market is seeing at this point of time. So I don't think there is a problem in equity markets because of a taxation increase. If the problem was there, we would have noticed it yesterday at this point.
And so it's done and dusted, right, behind. It's not as if there is some any lingering impact from here.
It's not that. See, we have to recognize where we are in the markets. We are in a market at this point of time where valuations are high, sentiment is exuberant, macroeconomics is fantastic. So and India is one of the best structural stories in the world for the next few decades. So the combination makes it very complicated, because do people look at the next few decades of structural growth and say, let's pay up for it? Or say India is one of the best macro in the world? Or people say valuations are so high compared to the rest of the world that you have to be cautious. Which of these things do you look at? It's a very difficult problem, particularly for a global investor. From a domestic investor point of view, people, I think, are not investing in debt at this point of time, because they're looking at the remaining two and saying that let's look for the long term. So that's why the government has done something more interesting outside equity, which is bring down the price of gold substantially, reduce the capital gains tax on real estate. So, we are not experts in these asset classes, but how do people react to that? How do people react to a big drop in customs duty and gold and drop in capital gains tax on real estate without indexation? It beats me. I'm not able to understand, because yesterday real estate stocks were down because capital gains tax on real estate was down without indexation. So this is something which maybe I can't...
Naren, so we were just discussing that before you came on real estate. Is it for legacy old property, this is negative? I mean, if you bought something very cheap 20, 30 years ago, and now you're going to pay it for, this tax without indexation. But for new property sales, isn't this, even if So if you buy something now and you sell after 24 months, you pay 12 and a half, not 20. Even if you bought at that point without the intention to sell, in theory, the taxation is now much lower. So from a stocks perspective, isn't it positive?
Yeah, even forget from a stock point of view. Today, for example, if I invest in a 2-year, in 2 years in in our liquid fund or money market fund, you are in the top tax rate, you end up paying more than 33 or 38%. Whereas you invest in a property and sell after 2 years, you're going to pay 12.5%. There's a huge difference in taxation between investing in real estate and investing in debt mutual fund today. Is that something which is logical at this point of time, that debt mutual funds are the most hated asset class at this point of time? So I think slowly over a period of time, the government is saying, do not invest in debt, and invest in property, invest in equity, invest in these kind of asset classes. And that is what may happen, because slowly over a period of time, debt has become the only asset class where you're charged at the marginal tax rate, whereas both in property and equity, you get very, very favorable tax treatment at this point of time. So is that
Naren,
okay,
got that, yes. Got that. Hi, good morning. This is Sonia here. I was going through a piece that you had put out where you mentioned that now you're starting to get a bit cautious on the mid and small cap space. And across the board, you are seeing a bit of fair valuation, slightly higher, above fair valuations for the broader market. So what does one do now? If you get a dip in the market, do you think the best way to approach it is to stick to large caps and perhaps churn out of mid and small caps?
So actually, for the last 1 year, we've been cautious on small and mid caps. But small and mid caps have kept going up. And it reminds me of the period, we used to always come on TV and say FMCG, we are cautious. And FMCG used to continue to outperform. Then we have had a 3-year run between 2020 and 23 where FMCG underperformed the market 100%. So we seem to be into one of those phases where we continue to be cautious on small and mid caps, but small and mid caps keep going up. But what happens is, what we've seen is, when you have these accumulated underperformance of overvaluation, it shows up later. And when it shows up, you don't know. No one knows. But we are believers in asset allocation first. Then we are believers in flexi cap and large cap. That's how we look at it. Doesn't mean that today onwards, small and mid cap starts underperforming. The more it outperforms at this point of time, just like what happened in real estate between 2013 and 2020, or in consumer stocks between 2020 and a few months back, you can have long period of underperformance after the overvaluation. And we are not astrologers to know when the top of this FMCG or top of real estate will happen. If we knew, I would tell you, but I don't know.
All right. Hi, Naren. Good morning. Good to hear your thoughts and always good to see you in. Tell us your thought process now on some of these value buys. Energy fund has raised a fair bit of money. Stocks like NDPC, ONGC in the past have been quite positive on. What's the thought process from here on?
Finally, at the end of the day, there are three things we depend on. We are dependent on moving from one place to another. So we need energy. Without power, we can't do this. Without telecom, we can't do this. See, we are always believers in this, but even these three sectors are not cheap. So the public has given us a lot of money to manage and given us a tough, responsible job on how to handle this market, because I wish these stocks were cheaper. So we'll have to handle this fund with the care that it deserves, given that public has given us the money. So it's a tough job. The challenge with the mutual fund industry is, 4 years back when the stocks were cheaper, we had to defend our investment in these stocks. Today, when the stocks are costlier, people have poured money and given us. So that is a tough job that we have, and how to handle public money in this area is one of the tougher jobs. But markets across the board are not cheap at this point of time. And we have a tough job grappling with all the money that we have and have to manage on an incremental basis. That is why we tell people be defensive, follow asset allocation, and that's the way to go. And it has nothing to do with the budget.
Yeah.
I think it's a
Yeah.
super budget. They have done exactly what is needed at this point of time, because
Right.
in all areas where things can be borne, they have increased taxation. But there is no way in which you can have a situation where it means that markets are cheap at this point.
Okay.
All right, Naren, we need to take a break. But before we do that, I just want to quickly understand your asset allocation strategy. As you said, there's been some tinkering in taxes for equity, but the other asset classes as well, there's been some tinkering in gold as well as real estate. And asset allocation is going to be key. So what would your strategy be as of now?
So clearly, one should follow. In between, we used to think gold had gone up too much. Now, with this big drop in customs duty, gold prices in India have crashed. So what happens is, again, multi-asset kind of strategies become very, very interesting because of the drop in gold and silver following yesterday's sensible drop in customs duty. So I would say multi-asset kind of strategies are the par for the course at this point of time for long-term investing, where you do not put all your eggs in the equity basket alone and bet on all the asset classes
Naren,
at this point.
You want to give us a weightage for each of these asset classes if you're deploying fresh money?
These kind of things can't be done. It depends on individuals' capability. There is no such model which exists where you can apply one size fit models.
I just want to sort of press upon the debt mutual fund aspect just one bit longer, because, I mean, you've been kind of championing how debt has been ignored as an asset class. Everyone is piling in into equities, and now you got this, as you also said. You said, well, the indication seems to be from the government that don't invest in debt. Invest in gold, real estate, maybe stocks, of course, with higher tax even, but debt, it becomes very unattractive in that sense. Would you agree, Naren? And would you see shifts in terms of flows from investors?
I don't know. I think inadvertently this seems to have happened at this point of time. I don't know what is the situation, I think, but I don't think it was a planned thing. But government, whether it's a government, what's happened, it's very difficult. But right now, for us, for example, we are not able to convince any of our investors to invest in debt mutual funds. They are very, very equity focused at this point of time. That's what we're seeing at this point of time. So, but what we have seen over a period of time is debt plays a very important role in every person's asset allocation. So instead of focusing on debt, we have to think of getting them into asset allocation strategies or hybrid strategies at this point of time. And that is what we try to get people to do at this point of time. And
convincing them now is going to be even more difficult.
No, it's not that. See, our view is, basically, there has to be a bit more volatility in Indian equity. If there is no volatility in Indian equity, people think that why look at debt? The day we see it, we've got 10, 11 years, thanks to fantastic macro management by the government of India and Reserve Bank of India. What has happened is we have not seen much of, movement of markets downwards. So you have not had a down year for so many years in equity. So people have come around to this view that equity is a safe asset class without a risk of a downward move. I think the year there is a downward move, I think that will come back. That is how we look at it. But right now...
Got it. Just one more. I just want to press this in. Rural allocation from the government. I take your point on the volatility bit. Rural allocation for the rural sector is down once again. I think it's down for the last 5 years. Every year it's down. So there was some expectation that at a mass level, rural, etc., there'll be that support from the government. It's not happened at all. Just your thoughts on any bets that people have been making and any implications for stocks.
I'm not an expert, because if you look at the way MNREGA allocations have been going up and a lot of indirect things that are happening, for example, most of the road construction that happens through the highway programs in various ways. Even the expressways happen in rural areas. So how you count the rural allocation is a bit of a this thing. If you look at the way, if you talk to most of the construction companies, they tell you it's so difficult to get labor at this point of time. So, I mean, it's very difficult to correctly predict what is the amount of money which goes to rural area directly and how much goes indirectly. So I think it's not fair to the government to say rural allocation is not there. It goes through direct channels and it goes through indirect channels. And that is how we see it. And maybe that is just looking at just some rural indicator alone is not the way to look at it.
No, I completely take your point, direct and indirect. But the printed number is what I'm going with. So that is down. That's what I meant. Naren would have sort of lots of other points to discuss, but we are completely out of time. And you have a very busy morning as well. So thank you very much for being with us here on CNBC TV18. Thanks for your time here,
Thank you.
as always, and good chat. We'll take a